Keith, some very smart people think that the Fed is trapped and will not be able to raise much further without seriously damaging the market. Do you believe this to be the case?
Well, it's good that they're very smart. I mean, what would be the corollary to that? Me, that's very dumb? Very smart. That's very smart. What are you going to do with that? If you think that rates can't go higher because you think very smart people think that, that's great. But that's not what I wake up. I literally don't care what very smart people think. There's a much smarter thing out there, and it's not even human. And that's why I care so much more. I call him Mr. Market, but so it's not really a him. It might be a she. But that's the far smarter macro strategist, an economist, risk manager that you should be paying attention to every day. There's so many smart people I've met in my life. I had the lowest SAT score at Yale, believe me. When I came in there, I saw that every single student was smarter than me on paper. But again, you can look at what smart people think. You can also look at what practitioners who have a smart process do. And what I do is pay a very close attention to where bond yields are within the risk range and contextualizing that with the fundamental research view and the intermediate term trend signal. Currently on bond yields, the intermediate term trend signal is bullish for yields, bearish on bonds. You know where the top end of the range is, so if you get 242, that's where you sell that exposure, in as much as you buy and cover that exposure at 229. That's a much smarter way, I think. I humbly submit that's a much smarter way than just waddling around every day talking to really smart people. Now, this is a much better thing than whoever the smartest person out there is, which is where does the 10-year trade on a multi-duration basis using the Hedgeye signaling process? So trades, trends, and tails. Where are those levels of support? Let's go backwards in reverse. So you have 221 is the long-term tail support. The trend is it's 224, and the trade is 230. So you have a beautiful setup there. This is why so many people are so angry about this potential move higher in interest rates, and why the really smart people are saying it shouldn't happen, it shouldn't happen, the Fed's going to, it just can't happen. It's happening, okay? It's happening. So a smarter person would probably say, like, think about this. Maybe I should take a bunch of Wall Street people to my hometown, like where I live. There are a lot of bears, like real live bears, okay? We can go on a walk, or maybe a brisk walk or a run. Maybe I'll take different kinds of groups. And what I like to say is that we're going to see some beautiful scenery here, and we shouldn't see a bear today. Okay, so let's just pack accordingly and go on our way. Now, what happens in the still probable outcome that there is a bear that shows up within 30 feet of us? What do? Do we look at each other, a bunch of smart Wall Street people, and say, it shouldn't be there, it can't be there, it's not going to be there? There's a moment there where you can die. Like literally die, by talking about what should be happening versus what is actually happening. Now, I don't know if this is the right analogy, but maybe we should try this with some of these smart people, because I would love to see how they react in that situation. Again, the 10-year yield is currently trading above all lines of support. Not one, not two, all three, okay? So that's what I see in the marketplace, and I see the fundamental data confirming it, which includes reflation data reflating, and we have obviously real GDP growth data and profit data still right at the year-to-date highs. So again, that's more so my style and how I roll. I'm not trying to offend all the smart people. I'm just trying to be smarter than them.